Welcome back to another Morpheus swing trading video. Are you feeling the weight of recent stock market weakness? If so, you're in the right place because in this video, we highlight major support levels in the broad market that may soon bring you relief. Last month, we witnessed the S&P 500 index hitting a roadblock, stalling as it encountered major resistance at its 50-day moving average. Since then, it's been a consistent downward trend as investors made their exit amid rising volumes. But here's where it gets intriguing. The benchmark S&P 500 is now approaching a critical juncture. It's right on the cusp of a major support level, which is the 200-day moving average as well as the 50-week moving average. This presents a unique opportunity, a potential low-risk entry point for new long positions. But remember, it's crucial to stay vigilant. If support doesn't hold, swift exits will be essential. In this video, we analyze key charts of the S&P 500 and the Nasdaq and highlight these pivotal support levels. Why is this crucial? Because price action over the next few days could set the tone for the market's path throughout the rest of the year. So let's dive in to discover what may lie ahead and how to properly navigate current stock market action now. But first, remember to press the like button and subscribe to ensure you never miss out on our powerful market analysis videos. Also, we'd like to remind you this is not financial advice. This is simply our interpretation of what the charts say. So let's see what the charts say. The Morpheus swing trading strategy is based upon multiple time frame analysis. That is, looking at trends of different time frames. We also use a top-down analysis where we start by looking at the longer-term charts to get an idea of the big picture, and then we drill down to the shorter-term charts to kind of fine-tune the setup and look for potential entry points. So that being the case, let's go ahead and zoom out and start by looking at the weekly chart of the S&P 500 index. What you're looking at here is a weekly chart, which means that each bar you see here represents one full week of price action. So this is actually the S&P 500 over the past 3 years. And just to kind of recap, we had a bull market throughout 2021, and we peaked in the last week of 2021, which actually kicked off the 2022 bear market, where the S&P 500 was trending steadily lower. And then in the beginning of this year, we found support, formed a higher low, and we've been trending higher now throughout most of the year. But this is what I want to call your attention to, and that is that in July, we formed a peak, and we've been trending steadily lower since July. And if you look at the big picture of the past few years, that means that we've actually set a lower high. So we have this high from the peak of 2021 at the end of 2021. And now we formed a lower high here from July of 2023. So when you've got a lower high, that means that the long-term trend could be reversing to the downside, but it's too early to say that. But for now, we are aware that we've got a lower high, and we'd want to draw a trend line here and keep an eye on this potential lower high that's forming. Now, if we also take a look at the shorter term on the weekly chart, we can see that we've got an uptrend line that we just broke below. Notice that there was an uptrend line that formed with the lows of October 2022, and just barely breaking below that. We'll take a look at the daily chart here. You can see that, but that's a key level. But on the weekly chart, we've got a few other things going on here. First of all, we got the 50-week moving average. Now, the 50-week moving average, notice how well this has acted as a level of support and resistance in recent years. We trended steadily higher throughout 2021, and then when we broke below that 50-week moving average in early 2022, notice how that became resistance. Every time we rallied into that 50-week moving average, we couldn't get above it, couldn't get above it, couldn't get above it, couldn't get above it, and finally in March of this year, we broke out above it. So the 50-week moving average is a very pivotal level, and remember that a prior level of support becomes a new resistance after the support is broken. That's why when we broke below this level, that now acted as resistance. Now, since March, we've been trending above this 50-week moving average, which is bullish for the longer-term trend. But notice that the S&P 500 is now approaching this 50-week moving average again. And this is a key support level that could spark some buying interest. So let's go ahead now and zoom into the shorter-term daily chart of the S&P 500 and see how the picture looks different. On that weekly chart, remember that we formed a lower high and also broke below an uptrend line that's been in place for a year. However, the daily chart, when we zoom in, actually shows that we're approaching major support. First of all, we've got this 200-day moving average, the yellow line. And the 200-day moving average also, like the 50-week moving average, is a very pivotal level. Notice how the 200-day moving average has played out over the past couple years, acting as resistance when we're below it, resistance, resistance, got back above it, and now we're coming back into support of that 200-day moving average. We actually wrote an entire blog post detailing the importance of the 200-day moving average and how to use it. So we're going to go ahead and put a link to that blog post in the comments so you can check it out and learn more about the 200-day moving average. Now, we also are constantly looking for prior levels of horizontal price support and horizontal price resistance. And you can see here that we've got a major level of horizontal price support that the S&P 500 is coming into. Notice these prior highs from February of this year, and then again in April and May of this year. Those prior highs acted as resistance. And when we broke out above it, that resistance now becomes support. And you can see here that we're coming into support of that breakout level. And what we like is that this support level is roughly converging with the 200-day moving average. So we're always looking for confluence or convergence of support and resistance levels. The more levels that come together to provide support, the more important and more significant that support becomes. So we like that not only is there a 200-day moving average, that we've also got horizontal price support of that prior breakout level. So as we get a test of this 200-day moving average next week, we may actually see an undercut where we dip below this 200-day moving average. And if we snap back above it in a day or two, that potentially is a valid buy signal. When we get a reversal, you'd want to look at a potential buy entry above the high of the reversal day. So we'll keep our members of the Wagner Daily updated in the chat room and notify them of any new trade alerts for potential entry. But for now, keep an eye on a potential undercut of that 200-day moving average. Keep in mind here, we have been selling off in higher volume over the past couple of weeks, which is not a good sign. When we going lower in higher volume, it means we have distribution. So if we get a bullish reversal, we'd want to see volume spike higher to kind of confirm that reversal. So again, just to recap, on the weekly chart of the S&P, we've got a lower high that's formed from the high of late 2021. And we've also broken below this uptrend line that I drew. But when we zoom into the daily chart, so with using multiple time frame analysis, we've got a slightly more bearish picture on the weekly chart, but the shorter term daily chart means we could see a bounce in the near term. When we've got divergence among multiple time frames, such as a bearish trend on the longer term time frame and a bullish trend on the shorter term time frame, note that the longer term time frame holds more weighting. So therefore, that longer term downtrend that may be developing is going to hold more weighting than the short term bounce. But nevertheless, we're swing traders, right? So we're looking to trade only short term bounces as well, and then we'll look to get out and sell into strength. And if we break below this 200-day moving average, of course, there's also the possible scenario that we just break below the 200-day moving average and never look back, although statistically that's more unlikely, and that's more likely that we'll see a reversal, at least a short-term bounce on a test of this 200-day moving average. Next, let's go ahead and take a look at the Nasdaq. So again, starting with the big picture, the weekly chart, this is the Nasdaq 100 Index ETF, QQQ. And like the S&P 500, you can see that we formed a lower high in the summer of this year, a lower high compared to the highs that were set from the end of 2021. So we got to keep an eye on that. But the Nasdaq has been showing slight relative strength to the S&P 500. So tech stocks have been holding up a little better. And notice here that we've also got an uptrend line, but unlike the S&P 500, we have not broken yet below this uptrend line that's been in place for throughout all of 2023. So that's, again, a key support level here that the Nasdaq could find some buying interest. But if we break below that, then we could equally see a sharp sell-off. But again, if we zoom into the daily chart, we can see that relative strength better. Whereas we've got the S&P 500 already near its 200-day moving average, QQQ is still holding well above it. And on QQQ, what we want to take a look at is this horizontal price support that we see here from the prior lows. Notice how the lows of August have been acting as support over the past, basically the past week. We've several times tested that level and bounced above it. So if we get a breakdown below that level, actually below the lows of this this test here, the 351 level, then we could see a swift move back down to the 200-day moving average where the Nasdaq catches up to the weakness in the S&P. But for now, the Nasdaq is holding up better. So keep an eye on tech stocks, which are showing slight relative strength to the S&P 500. Now, if QQQ attempts to rally, we do have significant overhead resistance. First of all, we've got resistance of this downtrend line from the highs that were set back in July. And the downtrend line is definitely a key level that could provide some trouble if we get a rally. But before that, we first got to overcome the 20-day moving average, 20-day exponential moving average, and we got to get back above the 50-day moving average. So these are key short-term resistance levels to watch. If you're long and you're getting nervous about being long in the market, then look for a potential exit into strength on a test of this 50-day moving average, because that could lead to another stall and potentially a breakdown below these swing lows. To determine the market health, we not only look at the broad-based indexes such as the S&P 500 and the Nasdaq, we also look at the price action in individual sectors and leading stocks. And when we see leading stocks failing to follow through and failed breakouts, that's another sign that the market's getting weak. And that's what we're starting to see now. In fact, if you look at the industry sector ETFs, practically every single sector out there is breaking down except for energy. So not a good sign that we're seeing broad-based weakness in the market. In particular, take a look at IWM, which is the Russell Small Cap 2000 ETF, and look at the relative weakness here we've got in the Russell 2000. We had actually highlighted this in a video a few weeks ago, and we showed you the head and shoulders pattern that was forming. Notice the left shoulder, right shoulder, and head. And we said that could lead to a breakdown below this neckline and move lower. And guess what? That's what happened. We got follow through in that head and shoulders after we broke down below the neckline at 181, and we've been trending steadily lower. So that analysis we did in our video a few weeks ago played out as anticipated, with the small cap index dragging the market lower. So you really want to keep an eye on the performance of IWM, because unless the small caps get in gear, we may not see any significant momentum in the market. Generally, when people are feeling confident about putting risk on in the market, then we see strength in small caps. And when we see weakness in small caps, then that's often a negative sign for the market. We can see here there's basically a horizontal support that's really important. In fact, let's go ahead and zoom out to the weekly chart. We can see it better. Notice how on the weekly chart, we've got this support level between 163 and 168, this range right here, that could be in play in the coming weeks for IWM. So again, we wouldn't want to see a breakdown below this area. That'd be really bad news for the entire market. So again, keep an eye on the Russell 2000, because we're not going to see any, because we may not see any significant momentum unless we suddenly start seeing relative strength in the small cap 2000, and which is in the process of completing a downward pattern of the head and shoulders. In our stock market videos, we typically will highlight some individual stocks that are on our radar for potential buy entry. But in this video, we wanted to focus your attention really just on the broad market and the key trends that are developing both long-term and shorter term. So if I had to summarize overall, we'd say that it's looking a little shaky out there for sure. The momentum that we saw throughout most of 2023 has dried up, and we are seeing breakdowns of key short-term support levels, along with the major relative weakness in IWM. And we do have, again, the 200-day moving averages and 50-week moving averages, which could provide support for the Nasdaq and S&P. But if we bounce and form another lower high on the weekly charts, then we could be headed lower. So it really is an environment where you need to be nimble. It's an environment where I definitely feel safer swing trading as opposed to just buy and hold and hope that things go up. And that's why a swing trading strategy is really the way to go, because when you're a swing trader, it doesn't matter which direction the market goes, you can profit on both sides. If we enter into a new downtrend, we look to sell short on bounces into strength. Just like in an uptrend, we buy the pullbacks. So if you'd like to find out more about how the Morpheus swing trading strategy can help you successfully navigate the market and stay safe in weak markets, head on over to morpheustrading.com and click on stock picks and get started today with the Wagner Daily, and you'll receive trade alerts with exact entries and exits, as well as access to our awesome MTG Tribe community. See you in our next market video, and remember to trade what you see, not what you think.